Welcome to lecture 25 on risk management and insurance. In this lecture, we discuss some information problems in insurance markets. In traditional economic analysis, consumers and producers are assumed to have complete information about prices and products. You may be surprised about that assumption, because in the economy there are literally hundreds of thousands of products, and the consumers naturally do not know all the prices of those products when they make decisions, and also the producers don't know all those prices of those products. But still, this assumption is made in standard microeconomic courses, at least at the beginning, and even with that assumption, we get some quite interesting results in microeconomic courses. But truly, consumers do not know all prices, and they do also not know the quality of the goods and services that they buy. So that's about incomplete information. It's a branch in economics that has developed over the past 30, 40 years, and there were quite a number of Nobel Prizes in this field. So let's make some examples. The buyer of a used car does not know whether that car is good or bad. A bad car is called a lemon. And actually even the seller may not know it. That is a famous paper looking at the lemon market for used cars. That was one of the original papers written by Akerlof, and he got the Nobel Prize. Now, patients also lack full information about the quality of health services provided by a doctor or hospital. When you are ill and you go to the doctor, you go to the doctor because you would like to have information. What is your illness? You don't know it. The doctor may know it. So the doctor has more information than what you have, and you are actually willing to pay to the doctor, okay, for his expertise. And the only thing you can hope here is that the doctor then is honest, and that he does not sell you unnecessary procedures. In the credit market, the borrower knows more about an investment project than the lender. So in the credit market, naturally, we have a huge information problem. The borrower knows, okay, how he or she invests the funds. The lender does not know it. So there are other examples. There are a lot of examples. For example, in education, when you decide about studying at the university, you don't know in advance whether the program is good. You know afterwards, when you have taken the courses, whether they are good. But in advance, you will not know it. You don't have complete information. Truly complete information is not optimal. It's from an economic point of view, it's worthwhile to collect information until marginal costs equal expected marginal benefit. Let's draw a short graph for this. So here on the lower axis, I have pieces of information. That's a bit theoretical, or units of information. Of the upper axis, I have the marginal benefits and the marginal costs. So the marginal costs of collecting information, they will increase. You try to collect more and more information, but that gets more and more expensive. So the slope of this curve gets steeper and steeper. So that's the marginal costs. The marginal benefits of information is usually assumed to fall. if you have more and more information, it's additional information that you get may get less and less useful. So the marginal benefit of information falls. Well, that's a marginal benefit. And so you go to the point where the marginal benefit equals marginal costs. It's not worthwhile to spend more on information, because if you spend more on information, the costs here then will be higher than the benefit. So if you spend an additional dollar on information, now here you have those additional costs, but the benefit is less. Now down here, the marginal benefit of a dollar spent on information is bigger than the cost. So this is worthwhile to get this piece of information. So from an economic point of view, it's not optimal to spend a very, very large amount on more and more information. Somewhere you have to stop, and you stop where marginal benefits are equal to marginal costs. Now, sometimes products are bought without collecting information at all. So that's happening when it looks like this, the curves. Maybe let's draw it down here. We have some marginal costs. The costs, let's assume the costs are high. That's the marginal costs. And the marginal benefit, the benefit is not particularly high. Maybe here. That's a marginal benefit. So the curves never intersect. And so in this situation, where the benefit, the marginal benefit of buying information is less than the marginal costs, you don't buy any information. An example that I have here is buying petrol. Motorists buy petrol without checking the quality. You just go to the petrol station and you fill up the tank of your car, and that's it. You don't check the quality. The benefit wouldn't be particularly big to check it, because the quality is usually quite good, and the costs of checking the quality would be quite high. So you buy it actually without checking. Now that's different when you have an airplane and you fill it up with petrol. With an airplane, naturally, it's crucial that the petrol is good. So the marginal costs of checking may be high, but the marginal benefit of checking is also high, maybe with an airplane. So you will start to check that. So with an airplane, the curve may be again up here, the marginal benefit curve, because if the petrol is bad, then you will have an accident with airplanes. That happens quite often, that the petrol is bad for small airplanes. It has water in it, and then those airplanes actually you have accidents. So here you will check. Now there are many private arrangements and government regulations that reduce the information costs. For example, product warranties. You buy something and you have a warranty for 1 year. So you buy a refrigerator and they give you a warranty of 1 year. Then this reduces your information costs, and you don't really have to worry so much whether that refrigerator is good, and you buy it anyway. Now, with hotels and restaurants, we have those star ratings, 2, 3, 4, 5-star hotels and restaurants. Again, this is just a signal for you what is the quality of the service in those hotels and restaurants. So you will look at those stars. Now in insurance, in credit contracts, you use collateral and insurance. So let's think of a mortgage. You get a mortgage from a bank. You have more information whether you will be able to pay back the mortgage than the bank. So there is here an asymmetric information. You have more information. The bank doesn't have every information on you. So you have to provide a collateral. The collateral in the mortgage is your house. That's called the collateral. That's what you have to give in security. And if you don't pay interest on your mortgage, if you default on the mortgage, then actually the bank gets your house. The house is the collateral backing up that mortgage. Now, if you get the mortgage from a bank, quite often the bank require you to buy life insurance and health insurance. So in case you no longer can work or you die, the bank then actually still gets the money. So then you have product liability laws, that's coming from the government. So if a product is bad and there is an accident, then the producer is liable. Again, this reduces your information costs. So we have a lot of arrangements, private arrangements, but also government regulations that are designed to reduce information costs in the market. So in traditional microeconomics, we assume there are no information problems. People know everything. They know all the prices, they know all the products, they know how good those products are. But truly, that's actually not true. So over the past 20, 40 years, we got those models that also consider information in the markets, those information problems. Now, information problems are particularly important in insurance market. And the insurance company faces two informational disadvantages: adverse selection and moral hazard. Adverse selection happens when the insurance contract is being written. And moral hazard then happens afterwards when the insurance contract is valid, when it's running. So let's first turn to adverse selection. It occurs when the insurance company is unable to distinguish between the risks of individual clients at the time when the contract is being written. So the insurance company cannot distinguish between the risky and the less risky clients. That's particularly important then in health insurance. Now, the insurance company tries to find out whether you are healthy or not. They will ask you a question, but it will not know everything about you. In this situation, the insurance company may charge an average premium for the entire risk pool. By a risk pool, I just mean for all the clients. But that means that low risk people, they are overcharged. You see, their risk, the average premium for the low risk people is too high. And so they will actually refuse to buy insurance. And then the insurance company may just get stuck with the high risk people. The high risk people are naturally happy to pay only the average price. Their risk is bigger and they know it. They know that they are smoking cigarettes and so on. So here, if the insurance company just calculates an average risk premium for everybody, then the low risk people will refuse to buy insurance. The high risk people will be happy to buy insurance, but then actually this average premium will not cover that high risk, and the insurance market really may fail. That's the reason that in health insurance, sometimes the young people who are low risk, they are forced to buy health insurance. This was in the so-called Obamacare in the United States. young people, the insurance was mandatory. So they calculated an average premium, and then they forced the young people to buy the insurance. And it has to be done, because else a lot of young people will not buy, and the insurance company just gets stuck with the high risks. Now, the moral hazard refers to the unobservable change in behavior of policyholders after the contract has been written. So the second information problem in insurance markets is the moral hazard. Here's the moral hazard. It happens after the contract has been written, and just now here's the contract is running over time. We speak about ex ante moral hazard, that's before the loss event. Maybe the loss event is that your house burns down or the car gets stolen. And then ex post moral hazard happens after the loss event. Ex ante is just the Latin word for before, and ex post is just the Latin word for after. Now, insurance creates an incentive to engage in more risky behavior and reduce preventive effort. So that's particularly important in our cultural insurance, we will see. Insurance really may affect the management practices of the farmers. They may take bigger risks and plant more risky crops, and also plant when a drought is expected or when there is not much rain. So there may be more risky behavior, and there also it may also reduce preventive effort. They may prevent, the preventive effort is actually the effort to prevent losses. So in agricultural insurance, that's quite important. Also, let's say you buy travel insurance. If you have travel insurance and your bags get stolen, you don't care too much because you're compensated by the insurance company. So you don't do you do less preventive effort that your bag gets stolen. So this increases the expected loss. Moral hazard increases the expected loss. And insurance fraud is just simply an extreme case of moral hazard. So and here's the ex ante moral hazard. So moral hazard before the loss event. It may increase both the probability of a loss and the size of the loss. So this here, before the loss event, the behavior of the insurance buyers may change in a way so the probability of a loss increases and also the size of the loss increases. After the loss event, only the size of the event has occurred, so the probability can no longer change. Here, only the size of the loss event may increase. Maybe if you have hail insurance and the crop is damaged, then after the loss event, the crop is damaged, maybe the farmers no longer tries to salvage the crop because it's insured. That would be an exposed moral hazard. Now, moral hazard increases the monitoring costs of the insurance company. So insurance company has to monitor its clients. Do they change the behavior because of the insurance contract? Do they engage in more risky behavior? Do they have less preventive effort? So the insurance company must monitor the behaviors after the insurance contract is being written. Now, moral hazard is often regarded a less serious problem than adverse selection, because actually both the insurance premium increases and also the willingness to pay for insurance increases. So as monitoring costs, they just go into the insurance premium. The insurance premium is the So the adjustment for risks we have seen. There's a risk loading, but then we have also some administration costs, and here those monitoring costs would just go into the insurance premium. But the willingness to pay naturally also increases. The insurance buyers know that they behave in a hazardous way, so they will expect higher payouts because they change their behavior. So also the willingness to pay will increase. And so the insurance market here may actually not collapse. Just the prices for insurance go up, but the insurance buyers naturally know, okay, that they don't do preventive effort and that behave more risky. So they expect bigger payouts. Okay, that's fine. And so then they are willing to pay more. I do not completely buy this argument. You see, a poor insurance buyer may not be able to afford those higher premiums in the short run, even then in the longer run, insurance payouts will be higher. So with moral hazards, premium increase, in the longer run, payouts are higher, but a poor insurance buyer will not be able to afford those higher premiums in the short run. So we have to be a little bit careful with that argument. Now, Zweifel and Eisen, they analyze the insurance markets with adverse selection and moral hazard. In chapter 7, they do quite a number of mathematical models. I taught them here 5 years ago, but we do not have time in this course really to do this. So if you're interested, you can look at this yourself. It's probably not so important, those models, if you work in insurance markets. Those models here in chapter 7 are more important for regulators, for government agencies that regulate the insurance market and want to do it in an efficient way. They have to think about, okay, moral hazards, adverse selection, will the insurance market collapse? How should they regulate the insurance market? So if you work for a supervisory agency of insurance markets for the government, then this chapter here may be important for you. But it may be not so important when you just simply work in insurance market. So that finishes the lecture of today. Thank you.